Hello, everybody. I want to get us started today so that we stay on time. Thank you for joining us today for the lunch presentation of the 2023 year-end tax planning strategies and preparing for the tax season. If you're looking to start preparing for the 2023 tax deadline and want to get an update on any new tax changes, or just want to get more organized, you're in the right place. Today, Lisa and Kevin will discuss federal and state income tax planning, recent tax law changes, and related opportunities. I'm Carolyn Powell, Development Director here at Tronconi Seguir & Associates, and I'll be your host today. So real quick, there's a couple ways to engage with us. There's a toolbar on the right-hand side of your screen, hopefully. In there is a section marked Handouts. Go in there and you can get a copy of today's presentation and also the full bios of both our experts. There's another section in there marked Questions. Feel free to pop any questions in there throughout the presentation. We'll try to get them answered during the presentation, and if not, definitely at the end we'll save time for questions. So a couple ways you can engage with us. Immediately after the webinar today, there will be a survey that will be emailed to you. If you could just complete that, give us any feedback, let us know if this was helpful for you. There will also be an opportunity if you want to talk to Kevin and Lisa after the presentation, just put a note in there and they will reach out to you directly. So without further ado, let's get started. Tronconi Seguir & Associates is a certified public accounting and business consulting firm. Lisa Mrkall is a partner and CPA here at the firm with almost 10 years of work at the firm with our small business clients and individuals. Kevin is a supervising senior here at the firm and has over 7 years in public accounting, and he specializes in tax. So I'm going to hand it over to Lisa to get us started.
All right, thanks, Carolyn. Wanted to welcome everyone today. Today I'll be talking about tax planning for individuals, some best practices and various things to consider. In preparation for today, we took a step back and thought about what we've been seeing during the recent months and weeks, the issues clients have brought to us most often, their questions, and what they most often ask us about in terms of planning for themselves. So I'll just briefly go over our agenda for today. We're going to be going over some of the upcoming tax-related deadlines and due dates, some of the tax rates related to individuals, and understanding a little bit more about those. We'll review some planning related to investing, charitable giving, and retirement planning options and contribution limits. We'll review the continuing provisions of the Secure Act, a very brief estate and gift tax update, and some state and local tax considerations. So on your first slide, we have some due dates and reminders. This is a chart basically listing out the key deadlines and due dates for our individual tax return filers, anyone making estimated tax payments this coming year, and the due dates for gift tax returns and trust tax returns. Also note that the earlier your 2023 tax return, the earliest it can be filed, is January 18th. That's the opening date of the IRS when they'll begin processing 2023 tax returns. Okay, so in relation to our January early tax season deadlines, our January deadlines, we have the 2023 information reporting and electronic filing requirements for 2024. So this is an issue related to some individuals, such as our sole proprietors, and certainly many businesses. The IRS recently released final regulations changing the electronic filing requirements for many federal filers of a group of forms called information returns. The new regulations notably reduce the threshold for the number of returns required to be filing electronically. So the new threshold in effect is reduced from 250 to 10. If you file in aggregate 10 or more W-2s, 1099s, 1095s, those health insurance forms, certain excise tax returns, just to name a few. These have all been, these all have to be filed electronically if you file 10 or more in aggregate. So depending on the forms that your firm files, your business files, accountants, payroll advisors can usually be reached out to and to help facilitate the electronic filing should you need to do so to comply with this requirement. Okay, so what is my tax rate? So certainly a question we get asked very often from our clients tax bracket am I in? What is my tax rate? And of course, what can I do to reduce that? So not much new here for 2023, especially with regard to tax rates, except for the normal inflation adjustments. The current rates range from 10 to 37% and depend on income and filing status. We expect to see the tax rates change in 2026 after the sunsetting of the Tax Cuts and Jobs Act, at which time the highest tax rate could revert back to 39.6%. Our income tax system, as many of you know, is progressive, so income is taxed at the different rates as you move through the brackets. So not every dollar of income is taxed at the highest rates. The highest rate kicks in at about $578,000 of taxable income for single filers and $693,000 for married filing joint. Long-term capital gains and qualified dividends are taxed at preferential rates. These range from 0 to 20%, depending on the income and filing status as well. Self-employment tax totals 15.3%. Net investment income tax is taxed at 3.8%. The additional Medicare tax is 0.9%. And we have the AMT rate, which is 28%, but because of the increased exemption amount, phase out thresholds as a result of the Tax Cuts and Jobs Act, we are seeing very few taxpayers subject to the AMT still, but those enhanced provisions are set to expire after 2025. So what can be done to reduce your tax rate? A question we are asked, get asked very often, excuse me. Okay, so capital gains and losses. So before the end of the year, you should consider capital losses that may be available. Capital losses up to $3,000 per year may be used to offset your other items of ordinary income. Any capital losses in excess of $3,000 are carried forward indefinitely to be used against future capital gains. So first, be sure you are aware of what your loss carry forwards are to use in 2023 from your 2022 tax return. Then you may want to consider loss harvesting, maybe assets or investments that are on the downside that can be replaced with reasonable similar investments, offsetting realized investment gains with those losses. So be mindful of wash sale rules. A quick refresher on the wash sale rules. These occur when an investor sells a security at a loss and then purchases a substantially similar security within 30 days before or after the transaction. If you do buy the same or similar security within 30 days, the wash sale rule states you won't be able to take a loss for that sale on your current tax return. There's some strategies to avoid the wash sale rules, which usually involve waiting longer than 30 days to purchase the similar stock. There are exposure risks here, so certainly always check with your investment professional about those trades and strategies. The nutting rules, so short-term gains are taxed at ordinary rates, not the lower tax rates discussed earlier. Long-term gains are taxed at more preferred and lower rates. So to the extent you have short-term gains, you'll offset them with short-term losses, and long-term gains are offset with long-term losses. Just a quick note on cryptocurrency. Gains and losses from sale of cryptocurrency are required by the IRS to be reported on Schedule D and Form 8949 if necessary. This is the case even if you do not receive a tax form or a report on your cryptocurrency transactions. So usually within the accounts themselves, you can usually generate reports to show the activity throughout the year. If nothing else, the best practice is to keep track on your own of what you're buying and selling throughout the year, but hopefully that isn't necessary, and your system can give you those reports automatically. Okay, charitable giving and planning. So this is, of course, another way to reduce your taxable income. There are various AGI limitations. Giving cash to public charities is deductible up to 60% of adjusted gross income. Gifts of appreciated property like stock, up to 30%. Keep in mind, deductions for charitable donations are only available to those who itemize their deductions. So if your standard deduction is higher this year than the group of your itemized deductions, you'll lose out on the benefit of the charitable donation. I'll show a slide with the standard deductions here in just a moment, but if you think you're going to be taking the standard deduction in one year and itemizing the next, you can take advantage of bunching your donations into next year instead of this year. All right, if you want to give to charities throughout the year and make sure you get the deduction up front, you can give to a donor advised fund and get the deduction at the time you make the contribution. And at your discretion then, the amounts you've contributed to that fund can be distributed throughout the year. Private foundations are another charitable giving vehicle, but the AGI limitations are a bit lower. Gifting appreciated securities has tax benefits as well. The deduction amount is the fair market value of the stock. In addition to that, you'll not incur capital gains tax that would have been incurred had you sold the stock. And just a note on gifts over $5,000, gifts of property over $5,000 in appraisal usually is necessary by a qualified appraiser. Not required for publicly traded securities, but is for cryptocurrency. You're always advised to keep as much documentation as possible on your donations, especially on these larger type contributions. And certainly reach out if you aren't sure if your contribution needs an appraisal or not. Okay, qualified charitable distributions from an IRA. So this is another way to reduce tax charitable giving. Qualified charitable distribution, or QCD for short, is like a normal distribution from an IRA, which are normally taxable to the account owner. However, a QCD is tax-free only if it is paid directly from the IRA to the eligible charity and not paid directly to the IRA owner, even if he or she subsequently donates the funds to a charity. An individual at least 70 and a half when the distribution is made can exclude a QCD up to $100,000 from gross income. In the case of married couples, each spouse must have their own IRA, and each can contribute $100,000 each, so a total of $200,000 for those QCDs. All right, so the distribution itself is not included in taxable income, so therefore the charity is not deductible as a charitable contribution. And the QCD can count towards the individual required minimum distribution if he or she is subject to one in that year. A QCD satisfies the R&D or can count towards it. Okay, so as I said, I wanted to share a quick slide containing the 2023 standard deductions by filing status. As you can see, I've noted the additional standard deduction for 2023. This is an extra standard deduction. This is $1,500 if you or your spouse is blind, and if you're 65 or older. This is the married filing joint or separate add-on to the standard deduction. For single or household, the additional standard deduction is $1,850, and these get added to the standard deduction amounts. They're not available if you itemize your deductions. All right, so we'll talk for a moment about the sunsetting of the tax provisions of the Tax Cuts and Jobs Act, or of 2017, also known as the TCJA. I thought it would be important to mention that in about 24 months or so, the tax law changes as a result of the TCJA, such as reduced tax rates, higher standard deductions, the removal of the exemptions, to name a few, are set to expire. This will be at the end of 2025, so about 2 years from now. So the non-permanent changes could revert back to pre-TCJA levels unless Congress acts and reaches an agreement to extend at least some of these provisions. At this particular point in time, there's just a slight bit of political tension and general unsteadiness in the global economy. So this may be an opportune time to keep strategies for the near future. Okay, in terms of planning deductions, starting in 2026, the standard deduction will revert to about half of what it is now. This could increase the need once again to keep up with the various expenses that can be used towards the itemized deductions and planning for those expenses to the extent possible, such as charitable donations. A significant itemized deduction is the state and local tax deduction, known as SALT for short, the SALT deduction. So this used to be an unlimited deduction before TCJA, and now there's a cap of $10,000 that was not indexed for inflation. So this left many taxpayers, as many of you know, especially in states with high SALT taxes, such as ours, that limited post-TCJA to the standard deduction, since this was significant itemization previously. Okay, so after 2025, this limitation is set to be removed, and taxpayers will once again be able to fully deduct SALT taxes on their tax returns if they itemize their deductions. It's important to note that this is a very hotly debated topic, and so the limitation might be increased or removed even prior to the sunset deadline in 2025. Okay, so you can see some of the other tax provisions that may sunset here. I'll skip down to the last bullet, the itemized deduction limitation. TCJA suspended the itemized deduction limitation that was in effect prior to its passing. This was known as the PEAS limitation and prevented high-income taxpayers from whittling away at their taxable incomes by claiming very large and numerous itemized deductions. We may see the return of the PEAS limitation on itemized deductions when things start to sunset. Okay, so retirement plan considerations. Retirement plan contributions can also reduce your taxable income. There are various contribution limits. I'll show those on the next slide, but there are various types of retirement plans, whether you're self-employed or not, such as IRAs, Roth IRAs. You can make deductible or non-deductible contributions to IRAs, depending on whether or not you're covered by an employer's retirement plan, and there are income limits on contributions as well. Even children with earned income usually are eligible to contribute to IRAs. In terms of Roth IRAs, contributions are not deductible, but withdrawals generally are tax-free. There's no required minimum distributions, and there are income limits associated with making Roth contributions, so not everyone can make those contributions. There is the ability to convert a pre-tax retirement account into a Roth, but the conversion is taxable. You'll need to consider your tax rate now versus your tax rate in the future, your tax rate during retirement, and of course the potential for tax rates to increase in the timing of plan distributions. Conversions cannot be reversed. This was known previously as a recharacterization, and these rules were discontinued with the TCJA. Required minimum distribution. So certain accounts other than Roths require RMDs when you reach age 73. If the individual turns 72 in 2023, their first RMD will be for 2024, the year they turn 73, excuse me, and can be taken as late as April 1st of 2025. For those who turn 73 in 2023 through 2032, the starting age for RMDs is 73, and the first RMD must be taken no later than April 1st of the year following the year they turn 73. If the beginning age for RMDs is 75, for those who turn 74 after December 31st, 2032. Contribution limits. So here are some various limits on retirement contributions. The IRA contribution is $6,500, and there's a $1,000 catch-up if age 50 or older. We have a spousal IRA, so typically you need earned income to contribute to an IRA, but the spousal IRA relaxes that requirement and gives a spouse with low or no annual wages a way to save for their future as well in a tax-efficient way. It is a separate IRA, the spousal IRA, that is set up in the spouse's name, and you must be married and filing a joint return in order to open a spousal IRA. 401k plans are limited to $22,500 of contributions with a catch-up of $7,500 if age 50 or older. And SEP IRAs are limited to the lesser of 25% of compensation, or $66,000. Okay, so moving on to the Secure Act. So the Secure Act was originally enacted by President Biden in January of 2020. It's hundreds and hundreds of pages long, and was followed up by a second version called Secure 2.0, which passed in December of 22, so about a year ago, as part of the president's year-end spending bill. Secure 2.0 raised the RMD age to 73, when it was previously age 72 under the Secure Act. It removed the age limitation for making IRA contributions if still working and receiving earned income. It provided for penalty-free withdrawals of up to $5,000 or $10,000 per couple from 401ks or IRAs to help defer the expenses of childbirth or adoption expenses. So one of the most significant changes with the Secure Act is that it now requires inherited IRAs and 401ks to be withdrawn within 10 years of the owner's date of death. As a result of this, more Roth conversions are happening so as not to leave taxable IRAs to one's heirs. The Secure Act also allows taxpayers to use 529 funds to pay down up to $10,000 of qualified student loan debt. This is a lifetime limit to be aware of, not an annual limit that applies to each beneficiary. So for example, a family of 2 children can use $10,000 per child to repay their student loan debt. Okay, so on to an estate and gift tax update. We'll highlight some key items on this topic. It's a very broad topic. So just a few key items here. The annual gift tax exclusion amount is $17,000, which means that you can give this amount to as many people as you like without them counting towards your lifetime exemption. 529 education plans and 529 super funding is a term used to describe large 529 contributions using a 5-year gift tax averaging. This is a 5-year rule to spread $85,000 of contributions for gift tax reporting, or 20% per year. The total is excluded from the taxable estate and is not subject to gift tax. If you make payments directly to educational institutions or medical care providers, they do not count as gifts. The TCJA doubled the lifetime exemption starting in 2018 to $12.92 million in 2023 per individual. This is scheduled to go down to $6.2 million per individual after 2025, again with the sunsetting of the TCJA. So this is the time to consider maximizing your exemptions if you haven't already, especially since we don't know what the tax laws will be in the future. So making gifts now and making use of the higher exemption and the future appreciation of those gifts outside of your estate. Other estate planning considerations with regard to estate plan documents. Now is a great time to review those estate plan documents, make sure assets are titled correctly, review beneficiary designations, especially in retirement accounts. Step up in basis, so just a reminder of what this is. It applies in estate planning and estate transfers. When someone inherits investment assets, the IRS resets the asset's original cost basis to its value at the date of the inheritance, and their heir then pays capital gains taxes on that basis. Okay, so just a quick switch over to some New York State tax considerations. New York's budget for fiscal year 2023, enacted in April of 22, accelerates income tax rate reductions that were originally passed back in 2015 for middle income earners. The reductions in the tax rates were scheduled for 2025, but will actually take effect 2 years earlier than planned. So they're in effect for this year, 2023. The rates will range from 5.5% to 6%, where the previous tax rates were 5.85% to 6.25% for most New York single and married taxpayers. So a very popular area that we get questions on is the New York pension exclusion. So I just want to briefly mention 2 types of exclusions available to New York taxpayers related to pension and retirement distributions. The first is the subtraction from New York State income on line 26 of the New York tax return, called pensions of New York State and local governments and federal government. So these are public employee pensions distributed to employees of the US, New York State, and local governments within New York State. These are fully excludable for New York State tax purposes, regardless of the age of the taxpayer. There's a second pension and annuity income exclusion that makes its way to line 29 of the New York State return, the pension and annuity exclusion, that one's called. So in this case, the recipient of the distribution must be 59.5 years of age, and up to $20,000 of qualified pension and annuity income from your federal income is excludable. In the case of married filing joint taxpayers, each spouse is entitled to the $20,000 exclusion, and this would be for payments from IRAs, 401k plans, just to name a few. This $20,000 exclusion also applies if you receive pension and annuity income of a deceased individual. So as long as that deceased individual would have been entitled to this exclusion, the heir can receive that as well. So if the deceased individual has more than one beneficiary, this $20,000 exclusion must be split up and allocated among the beneficiaries. Okay, so one final New York State subtraction I'd like to talk about is related to the 529 plan contributions, since there's still time to make these contributions for this year, for 2023. So if you're a New York State taxpayer and a 529 account owner, you may be able to deduct up to $5,000 and $10,000 if married filing jointly of your direct plan contributions when you file your state income taxes. Your contribution, if mailed, must be postmarked by December 31st. And note that if you're not the account owner, you're not entitled to the subtraction from income. An example of where this can get tricky is if a married couple is filing separately and only one spouse is the account owner. In this case, only one spouse is entitled to the deduction, and it's limited to $5,000. Okay, so that's going to conclude my portion of the presentation on individual tax updates. Kevin will now take over and discuss some business tax updates and strategies.
Perfect. Thank you very much. Before we get there, though, there is one other section we want to cover here for some individual tax credits. There is a couple credits that are still available in New York State, or not only New York State, but on a federal level, that are important here because from our understanding, they were going to go away, but they have recently been extended or changed, mostly for the benefit of the taxpayer. The first one is residential energy credits. This deals with solar panels that you were going to put into service at your house. In the past, they were going to be eliminated, but they decided to extend this through 2034, and there is no lifetime max on this, and the credit has increased to 30%, and it's going to continue to stay 30% until 2032. Note that if you do have any use of your home for business purposes, this credit could be diluted or eliminated. Another credit that is still here and has actually been increased is the energy efficient home improvements credit. This used to be a $500 lifetime limited credit, but has now been raised to $1,200 or $2,000 depending on what type of improvement you have. This can include doors, insulation, skylights, windows, heat pumps, water heaters, etc. And the last credit that has been here but has now been modified for 2023 and 2024 is credits for clean vehicles purchased. In the past, you've been able to receive a credit for a new EV that you bought, but it couldn't be on a used vehicle. Now you can buy used or new vehicles and receive a credit. The only change now, or one of the changes now, is that there are income limitations that apply. It's different between different filing statuses because of single or married filing joint and married filing separately. These credits are now, like I said, are now allowed for used cars that you never used for, or never allowed for used cars in the past. And starting in 2024, there is going to be this new transfer credit that is allowed. This was, in the past, you could only receive it on your income tax return for the $3,500 credit, but now you're able to, in 2024, be allowed to use the $3,500 credit towards the purchase of the vehicle. And this could add into some savings on financing costs for purchasing your vehicle if you're going to go that route. All right, so now into the business tax updates. So just like Lisa did earlier in the presentation, we have this nice little schedule here for due dates and reminders. Important to know that a lot of these due dates are not much different than they were in the past. There's actually no big changes at all. And this includes tax filings, estimated tax payments, extensions, PTET elections, specifically for New York State, it has not changed. From our to what we know so far, there is no federal relief for additional tax or additional time to file or pay your taxes like there was during the pandemic. And you should suspect to be on a normal schedule for this year. All right, so a little agenda here that I have for supplemental for just the business side here. We're gonna review your current accounting method and what your accounting situation is at this point. Maybe a little refresher of where things are going and has this been looked at in a while. We're gonna look at Section 174 capitalization. What is this? Does this even apply to your business? The next section, we're gonna look at a whole slew of items to try to maximize your deductions, not only for the current year, but maybe for future years as well. Where should we be taking these deductions? And then lastly, we're going to get into this new item here called Corporate Transparency Act. This is brand new for everybody in 2024. So for accounting method changes and opportunities, this is kind of just a question for everybody. If you can think while you're having lunch right now, what is your current accounting method? There's two most common known methods called the cash method and the accrual method. There are different methods, but they're not as common. Do you know what the difference is? Do you know which method you're using currently? Has this changed in the last 15 years? Well, if people that don't know, the main difference between the cash and accrual method is basically when income and expenses are recognized. Under the cash method, payments received or payments being made for expenses are recognized when the payment is made. Under the accrual method, it's based on when income is earned or when expenses are incurred. So they have a little bit of difference for the bottom line at the end of the year. If you're a large business, does this conversation really even matter? Well, under the TCJA, they consider a small business to be any business that was under 25 million in gross receipts over a 3-year period. Well, that number has now inflated up to 29 million. If you're under the 29 million, you have the option of doing the accrual or cash method, depending on what's best for you. No. With that being stated, if you wanted to say do cash 1 year and accrual the next, you have to know that you're not able to switch back and forth each year. There are limitations in time periods in which you can go back and forth. If you're above the $29 million threshold, you're required to be on the accrual method. Not only are you required to be on the accrual method, but there are other limitations or other implications that you have to follow when you get onto that $29 million a year or more over a 3-year average. One of those being capitalization of specific expenses under inventory through section 263A, limitations on business interest expense through section 163J. And the important thing to know is both of those new items that would come into your business are on an aggregate basis. So if you have 2 different entities set up, one for the operating business, one for the rental business, both of those businesses would be subject to both of those rules. So you're on the accrual method. Is there any way that we can speed up any deductions, right? Well, there are some prepaid expenses you would most likely see on a balance sheet for an accrual method taxpayer. In most cases, those expenses can't be deducted until they have incurred. Well, the IRS a few years back has released some guidance stating that that's not always the case. If they're reoccurring and they fall under what they call the 12-month rule, and they don't extend for more than a year, which would be most common with real estate taxes or general business insurance that you would purchase, you are able to deduct those. Unfortunately, you can't just do that automatically on your return and decide to deduct when you want it. You have to file a form called 3115 for a change in accounting method. Most accounting firms know how to do this, and it's definitely a good area to find a deduction for the current year versus waiting until the next year. Our next section here relates to section 174. This is a hot topic to say the least. It's been a key feature for us for the last probably 18 months or so, and a lot of people are hoping to see this go away. But for people that don't know, starting in 2022, there was a new rule that stated that you must capitalize and amortize any of your R&E costs that incurred during the current year. In the past, this used to be an option where you can either expense or capitalize these costs. Most taxpayers would choose to expense the cost versus capitalizing over a 5-year period or possibly a 15-year period, depending on where this research has been done. Well, Kevin, I don't really currently take the R&D tax credit. Do I still need to do this? And the answer is yes. Most people would say, oh, well, I'm going to try to hide this and this and that. Well, it's not really necessarily something you should be doing. Whether you're taking the R&D tax credit or not is your own issue. So with the fact that now you have to capitalize these costs, you're not going to get an immediate deduction. Maybe this is a time to look to see, am I available to get this R&D tax credit? Is there a possibility we can do a study? Well, the good thing with us is that we have a lot of clients that do take this credit and have a lot of resources available for us to see if you qualify for these credits, especially now when it counts most. Like I was saying earlier, a lot of people are trying to get this pushed away or pushed it down the line. Congress is still in a position where this is going to exist, and they have released the IRS has released guidance on how to do this calculation in the fall of 2023. So I suspect, unless something really happens here in the next year or so, this might be here to stay. But who knows? I mean, Lisa was talking about before, it's kind of a heated environment in Congress right now. So we could get ruling tomorrow that this has changed. So this next section, section 199 Cap A, is a common section I know that many business owners probably know about. It's been enacted, it was enacted in 2017. It's called the qualified business income deduction. This is not so much a business tax planning strategy, but understanding that this deduction is still in place and will be in place through 2025. There has been no legislation yet stating that this will be extended. There's been opinions out there that this could be extended through 2025 for lower income taxpayers and phased out for upper income taxpayers. But as of right now, the deduction's in place and only in place through 2025. This deduction, as a reminder, is only applies to people, to taxpayers, that are a part of partnerships, S corporations, Schedule Cs, rental properties if they're considered to be a Section 162 trade or business, and one more that I left off here is states and trusts. There's a possibility for that deduction there as well. As in the past, there are still income limitations on this deduction. If you're under a certain threshold, you can receive the full deduction of 20% of your business income. But if you fall above that threshold, then there is a possible of a limitation or a phase out of this deduction. And if you are considered to be what's called a SSTB, which is a specific type of business that deals with services, you would be possibly subject to getting no deduction whether you are met certain limitations above the income thresholds. This next slide here is just a chart that shows the 2023 inflated income thresholds that allow you to see where if you're above a certain threshold for a certain filing status, you may receive the full 20% deduction. So that would be that middle column there. But on the right-hand column, there is a potential where you could receive no deduction or a phased out deduction if you're above that threshold. There are different limitations involved in different rules on that, but that is outside the scope of this presentation today. So I guess the main summary here is just to know that this deduction is still in place, and if you're looking to maybe speed up income into the current year, maybe there's a possibility where you can receive a deduction still on it versus trying to defer income into future years where this deduction may not be available. So this is another hot topic here for depreciation, for bonus depreciation. So in 2017, the TCJA decided that they were going to increase bonus depreciation, which is accelerated depreciation on property that had a useful life of 20 years or less, and they moved it from 50% to 100% depreciation. So in the first year, you could accelerate your depreciation on a fixed asset to be fully written off for federal purposes in year one. Well, they stated that in 2023 through 2026, this 100% rate was now going to decrease from 100 to 0%. In 2023, this is the first year we've seen a decrease, and it's come down to 80%. So it's still a lucrative item where you could receive a nice tax write-off in the first year for a fixed asset you place in service. But over the next few years, that number is going to decrease down to the point where in 2027, it's going to be 0%. Could they change that? Sure. But as of right now, in the letter of the law, it's going to be 0% in 2027. An important reminder here is that when bonus depreciation is a very good federal deduction, it is not allowable under New York State. So you could see a year where you wrote off a bunch of assets and you have no taxable income, but you could still have taxable income in New York State because you weren't able to receive the same benefit. Unlike bonus, Section 179 can look a little bit more pretty for New York State. Similar to bonus depreciation in the past, 179 allows you to have an immediate deduction for eligible business property in year one of the asset being placed in service. New York State does follow this in most cases. There's a couple exceptions, but 99% of your cases, you're going to see the same deduction for New York as you would for federal purposes. Not everything can be perfect. So bonus depreciation, there's no max and how many assets you place in service or how much the deduction can be. But for 179, there are cap limitations. You can see on the screen here that what these limitations are going to be for 23 and 24. There's a overall deduction limitation for the assets placed in service, and there's also a limitation how many assets you place in service entirely. Important note here is that 179 cannot be taken to bring you into a loss. And if you have 179 coming through from multiple flow-through entities, if you end up having more than, well, in this case, 1.16 million in 2023 for 179 expenses, if it gets to the individual level and you see that there's more than that on there being trying to be claimed, it could be lost forever. It could be eliminated, and the problem is that when you get on the back half of the fixed asset when you're trying to sell it, you may have to recoup on recaptured 179 costs, even though you never took the deduction in the first place. It could be a double whammy there. So the next section here is not necessarily a tax planning strategy, but this is more to help prep for the tax season and understanding that there are items that you have to capitalize versus expensing. And this deals a lot with repairs. This is something that came out in 2013 and 2014 and has been highly utilized since. So in general, if you have a taxpayer, they have to capitalize any sort of improvement they made on a unit of property. What does that mean? What does improve mean? Well, did you make a betterment to the unit of property? Is it bigger? Is it stronger? Is it part of a structural unit? Has there been any sort of restoration to the unit? Has there been an adaptation to the unit where it's now for a different use? These are all different sources of what a property is being improved by. Well, when we can say that the cost of the repair should not be capitalized, is there any go-tos? Is there any sort of ideas we can use here? Well, was there any sort of structural changes, right? Everyone wants to expense if they can. Is there framing on the building that would make the building stronger? Well, if you did that, that's not really a repair. But if you decided, well, I'm only going to replace part of the property, if I have one unit of property, which would be one unit or one window out of 50 units or 50 windows in the building, well, that's only part of the property. Consider that to be a repair. It's a minute amount of the unit of property. Was it routine maintenance? Well, even if it's over $2,500, which we'll go over that in a couple seconds here. Like if you go to a truck repair shop and you get your fluids and brakes changed on large trucks, you could see bills for $4,000 to $5,000. But if you're doing that on an annual basis, they see it to be routine maintenance. Some other considerations here are the minute selections and the per item approach and updating your company capitalization policies. For de minimis selections in 2016, they decided to raise the amount from $500 to $2,500. And if you have an audited financial statement, it is now $5,000. It can't be a reviewed statement or a compilation, it has to be audited. And essentially what happens here is that if you have any repairs or any sort of small fixed asset you put in service, those items can be immediately expensed without capitalization if they're under those thresholds. This per item approach, it follows the same suit, except if you have an invoice that shows I have 5 chairs that are $10,000, okay, I'm above the $2,500 threshold, or even in this case, the $5,000 threshold. But if it's specifically listed on the invoice that it is 5 chairs for $10,000, you can actually expense all 5 of those chairs and put them on the correct category and not put them on the balance sheet. Why is this a big deal? Because when it gets to tax time, you're most likely going to get an email from your accountant stating, hey, can we have a copy of your GL for your fixed assets and your repairs and maintenance? And then we're going to have to go find the GL, send it to them. It creates delays. And if we can somehow clean this up before we get to that point in time, it's more efficient on our end and more efficient on the taxpayers' end. And that's the small item at the bottom there, updated capitalization policies. These might be items that your company hasn't touched in 10 or 15 years. It's something where this needs to be updated. There are definitely some increase in costs, so maybe this is something you have to refresh. Maybe it used to be $1,000 before. Maybe we increase it to $2,500 now, so there's less confusion on the fixed asset schedule, and this makes things more efficient. Next section here, I got to speed it up a little bit. Cost segregations. I'm sure if everyone's ever heard about what these are. Essentially, a cost segregation study is a way to accelerate depreciation using a team of tax and engineering experts to take various components of a building and determine if we can accelerate our depreciation on certain components of it versus depreciating the entire building over 39 years. The primary goal, like I said, is to break this 39-year property into different buckets, short-term buckets, which would be 5 years, 7 years, 15 years. Once reallocated into these new buckets, Section 179 and bonus depreciation can be taken on those assets to potentially create a new or accelerated depreciation deduction for the current year versus waiting until 39 years. Most cases, if you're waiting 39 years from today, most taxpayers are going to be retired from that business. So that's a long time to wait. Well, if I decided that I put a building or remodel into service last year, did I miss out on this opportunity? The answer is no. There are ways to go back and catch up on depreciation through after the study has been completed. Of course, there has to be a 3115 change of accounting method file form or form file, but you can still take advantage of this. So don't be afraid that I did it 1 or 2 years ago, then I'm done and out. There is a possibility for that. Just for informational purposes, when is this recommended to do? Is there a certain dollar threshold you recommend? Usually this is on projects that are $1 million and up where you can see the advantage because it does cost money to do the study itself, but you can reap more benefits if it's on the $1 million and up threshold. So our next section here, we're gonna talk a little bit on business loss limitations. This is something that was also added during the TCJA era, and it is currently still in effect through not only 2025 when the TCJA is supposed to sunset, but has been extended through 2028 through not only the American Rescue Plan Act, but also the Inflation Reduction Act. So it will be around here for another 5 years or so. Loss limitations have been increased due to inflation to $289,000 for single filers and $578,000 for married filing joint. Just a note here, this only applies to pass-through, sole proprietor, and rental properties at this point. This does not apply to Schedule C corporations. I did have an example on the next page, but I think that we are going to pass on that. Well, we can talk about it for a couple seconds here. So essentially, it's just shows an example of a single taxpayer that runs into a position where they have a loss and they're not able to capitalize on the first year. Well, when you have no planning that's involved, you'll be showing a lot of taxable income in year one. Is that $5 million S corp loss from the taxpayer is not going to be utilized and it's going to be pushed forward to the future. And you'll have a nice NOL coming forward, but who knows if you're going to be able to utilize that. If you decide that you want to do tax planning, there's possibility maybe there was that $3 million stocking we had can be pushed into January 2024. You're still going to have the NOL that's produced in 2023, and you're going to have not a lot of income as that $3 million stocking was pushed forward to next year. But now that NOL can offset a lot of that stocking in 2024 to help push ahead and speed up that deduction versus waiting for many years to try to utilize that. So this is an idea of trying to not only limiting income for this year, but also trying to speed up the usage of the NOL. All right, so this is another hot topic here that a lot of people know about. And if you don't know about it, well, we're glad you're here today. So New York State PTET, also known as the pass-through entity tax, this was a hot topic that was discussed immediately after TCJA that came out, mostly because of that SALT limitation that Lisa was talking about earlier. Since taxes are only limited to $10,000 in deduction on the personal return, there was a lot of individuals that especially lived here in New York State, in the Hamptons area, that were paying a lot more than $10,000 a year in real estate taxes and an estimated tax payments for their returns. So the government wanted to come up with a new plan in order to find a way for people to deduct these taxes. And one way to do it was to do it through the entity's return. So starting in 2021, they have now created this new optional tax that you could use to pay your estimated tax payments for the shareholders, for certain shareholders anyways, and pay for your estimated taxes through the business and receive a full deduction for it. This was almost a win-win for the taxpayers. Like I said, this essentially was a get around to get away from the $10,000 SALT limitation on Schedule A and fully deduct your taxes. Okay. So an example of this would be a business that created $1 million of income in the current year and essentially would have a tax of $68,500 due to New York State based off a 6.85% tax rate. In the past, you would only be able to deduct up to $10,000 in Schedule A for these estimated tax payments you'd have to make. But now with the election and the PTT, you would be able to deduct these taxes against your S Corp or partnership income of $1 million and now only pay federal tax on $935,000. This would then produce about a $20,000 tax savings on the federal return, and your state taxes would still stay the same. Versus if you go onto a Schedule A, try to deduct this $68,000, you may not receive any benefit because you're already capped on the real estate taxes, or you might receive up to maybe a $3,500 benefit if this is the only tax coming through on Schedule A, if you were even itemizing. And now I'm actually going to switch it back over to Lisa. She's going to talk about the increase to the small business subtraction modification.
Okay, thanks, Kevin. So we always find the need to raise awareness on this topic. We find that not a lot of businesses are aware of this subtraction modification. So this is solely for New York State. It is a reduction in income for New York State sole proprietors and now some partners and owners of S Corps. So this was previously available only to sole proprietors with at least one employee and income less than $250,000. So at the beginning of 2022, this was expanded to include owners of New York S corporations and partners and partnerships with one or more employees. So that hasn't changed. And net income of less than $250,000. Owners of the S Corp, those shareholders and partners and partnerships with one or more employees and less than 1.5 million of New York gross receipts are the individuals that are allowed to take this subtraction adjustment. So this percentage of income that is subtractable has gone up from 5% to 15%. So we wanted to just, again, raise awareness on that topic.
So we did have one question that came in here. We'd like to answer it on here if we can. Question states PTE payment or PTET payments are due on 12/15, which is correct. But if the client pays them on December 22nd, so 7 days after the deadline, would you still be able to deduct these, but a late fee would apply? Well, the answer is yes, you can still deduct them as long as you make the payment before December 31st, you are fine on a cash basis. If you decide to make it 7 days after the payment is due, there are penalties that could be involved during the filing of the PTT return, but that doesn't mean that you can't deduct your estimated payment that you made in December. I hope that answers your question. Before we get to the Corporate Transparency Act section, I wanted to talk about a couple of business tax credits that are still available here and should be utilized by taxpayers if they can. So they have the work opportunity credit that's available for retailers and other businesses that have a lot of turnover in terms of employees. They have research and development tax credits, which are very lucrative at this point, knowing that we have the 174 capitalization policy. I think we talked about that before. Brownfield credits in New York State have been extended through 2032. These were set to expire. The alternative fuel vehicle refueling property tax credit, aka charging stations, those are now available in for federal and New York. The tip credit for restaurants is still around for federal purposes. This has been talked about to be extended into the beauty industry, but still officially has not been extended. There are plenty of manufacturing farming tax credits in New York State, and the alcohol beverage production credits are still available in New York State. So take advantage of these credits while you can. The last section here we're going to talk about very briefly, knowing that our company is going to be doing a webinar on this topic itself. This is a brand new topic for 24 for all businesses. It's called the Corporate Transparency Act. Essentially, there is a new informational filing that's going to need to be done with the US, and it is basically just on general information, the name, address, EIN, business activity with each business that is in the United States. Also, you have to report information relating to the business's beneficial owners. Well, Kevin, do we have to file this thing? Can we be exempt from it? Well, they always have an exception for something. And there are companies that will be exempt from this. Mostly are going to be businesses that substantially already report to the federal and state regulations. Example of this would be like a company that's publicly traded that is dealing with the SEC, or for people that are like us that are not publicly traded, you would have to meet the large operating company exception. So this would be businesses that employ more than 20 full-time employees in the US, businesses that have an operating presence in the US, aka an office in the US, and you would have to meet the requirement that your business had federal gross income or federal tax or federal gross receipts, of more than $5 million in the previous tax year. Okay, well, Kev, I don't meet any of those requirements. When do I have to file this thing? Well, if your entity was created between or before 2024, so before the end of this year, then you have until the end of next year, December 31st of 2024, to make this final. If you were created after the 1st of January of 2024, you have 30 days after formation to file this form. Okay, well, now I figured out that I have to file this form. Where the heck do I do this? Well, we've supplied another couple of links here that shows a brochure of what you need to look at to see, do I meet any of the exceptions? There's actually 23 exceptions to filing this form. I only listed out 12 here because that's all the allowed space I had. But there's also another web page here that shows exactly where you would have to file this. My recommendation is before you file anything, talk to your attorney or talk to the state representative you had to set up your company and see, do I have to file this form and could we get some assistance on filing? Because not only does this matter for operating entities, but this could be set up, or this could be an issue for an LLC you have set up just for a rental property you have on the side, or an LLC that you had set up 5 years ago that has been utilized.
All right, that was a lot of hot topics that we got here this afternoon. I hope everybody enjoyed the webinar. Bill, I hope that we were able to answer your question. If you have additional questions to that, let us know. And Jeremy, I did see your question pop in here. Lisa will respond to you directly via email because it's a little bit lengthy of a response to get into today. If anybody has any remaining questions, again, pop those into the question box and we'll get those answered for you. Just a reminder, a survey will be coming out immediately to you just for some basic follow-up. And if you'd like to set up a time to talk to Lisa and Kevin and give us any feedback on the presentation, I will be emailing you either later this afternoon or tomorrow morning the recorded version of today's presentation, and again, another copy of the handouts if you want to go back and listen again and or share with a colleague or somebody you know that missed the presentation. So those will be sent out to you also. So I want to thank our experts again today. That was a lot of good information, and if we can help you in any way, reach out to us anytime. Thanks for joining us. We'll be coming out with our 2024 webinars in January, so we'll be seeing you again then. Thanks, everybody.